Hey everybody, Economic here. I hope you're doing well. I want to talk today about a very bad sign for the markets. We've been talking about the bond market for quite some time. Why is it so important? The bond market has always been this pillar of strength and pillar of stability when it comes to financial markets. And that is not the case in the last couple of years. As a matter of fact, we have not seen a bond collapse at this magnitude where we've seen 3 years of consecutive bond losses since the 1700s. This is a big deal. Bonds are tied to so many other financial instruments. Primarily right now, the 10-year and what's going on with mortgage rates is really the headline of the story. But what we're going to talk about is a warning that came in from Bill Gross, the bond king. We're going to talk about yields jumping and what just happened with the 5-year Treasury auction. Very important to know. And really looking at the big picture, and that is that countries are not showing up to buy our bonds. We are finding it now impossible to export our inflation around the world, a luxury that our government and the Federal Reserve has taken full advantage of for approximately the last 50 to 60 years, 50 years for sure. And we are seeing on a massive scale countries completely abandoning us. I can't say that I blame them, but I want you to understand that it is going to affect everybody in this world, and especially everyone in this nation, when the chickens come home to roost. Because pretty soon, all of those dollars, they're already starting to flood in from countries that are walking away from the dollar. They're selling their treasuries. They're selling dollars. And that is going to make things a lot worse for the consumer here in America. All right, so there's two stories I want to talk about. First, this one's out of Zero Hedge. It's a short one. It's entitled Yields Jump After Gruesome 5-Year Auction Prices with the Biggest Tail in 15 Months. It says here, well, the Treasury market respite from the bills closing out their shorts was, as expected, quite short-lived. And moments ago, the pricing of an ugly 5-year auction reminded us just how much more pain lies in store for the U.S. bond market. It says the sale of $52 billion in 5-year notes were priced at a high yield of 4.899%, which is more than 20 basis points above last month's 4.671%, the highest yield since June of 2007. This is very important for people to understand. As governments and companies continually need to issue new debt to stay solvent, all right? That is where we are. Our country is not solvent. It brings in less taxes than it spends. It is busy spending money on proxy wars around the world. It is spending money buying votes. It is spending money recklessly, okay? So the government has to continue offering new debt, and it has to keep raising the amount at which it offers that debt at. Think about it. An institution, the bond market, it's an institution, has been trusted for so long as a pillar of stability, and now it is one of the reasons why the banks are collapsing and needing more funding from the Federal Reserve. Because in all of their held to maturity bond portfolios, they're collapsing in value because the rates keep going up. And there are so many factors involved with the rates going up. It is not simply because the Federal Reserve is raising their benchmark rate, okay? This is different than before. People need to understand that. Type 1, if you think that this bond market is not done melting down. Type 2 if you think it is, because we're going to get into another story in a second from the bond king, and he thinks that it's going to be over. I do not think it is. All right, so going back a little bit more into this 5-year auction. It says the bid to cover of 2.36 was also rather ugly, and not only was it below last month's 2.52 and the 6 auction average of 2.55, it was also the worst since last September. It says the interest or the internals were even uglier, with indirect sliding by almost 10 basis points to 61.5% from 71.2%, the lowest since, you guessed it, last September, and below the recent average of 68.9. And with directs awarded 19.1%, or roughly in line with the recent average, dealers were left holding 19.4%, which is the most since last September. All right, so we have fewer and fewer foreigners buying our debt. We have yields that are just screaming up, right? It is affecting the car debt market, the vehicle debt market, the housing debt market, every debt market, commercial mortgage-backed securities, everything is imploding. And yet you have the Federal Reserve saying that we are going to keep rates higher for longer. They have not broken the backbone of the economy, and the economy is you. They want you unemployed. All right, very important to realize where we're at in this day and age. All right, so now let's do this. Let's get to the next story, and it's out of Fortune. It's entitled "Bond King Bill Gross Says It's Time to Stop Betting Against Bonds and Get Ready for an Economic Slowdown, Recession in Fourth Quarter." It says here the recession, Bill Gross says the recession is coming in the fourth quarter and to prepare. So here we go. Let's read this. Even some of the biggest bond bears on Wall Street fear that they have flown too close to the sun, saying that the market route on Treasury bonds has pushed too far. First, billionaire investor Bill Ackman, founder of Pershing Square Capital Management, wrote, "There is too much risk in the world to remain short bonds at current long-term rates." Now, Bill Gross, an activist investor, saying this, I think is really interesting because, like I said before in the beginning of this video, the bond market, the institution of the bond market, has always been this safe haven, right? Yet it's not anymore. You see, we've had 3 years of losses in the bond market as rates keep going up. Why would people dive into bonds right now, especially anything outside of 30-day, right? Or 1 year, short-term, assets. Why would anybody dive into that after watching portfolios collapse in value? And you have the Federal Reserve saying, no, we're gonna keep raising rates. They're still going to raise rates, regardless what the argument is. If it's just 25 basis points this year or 50, whatever, they're gonna raise rates, which is gonna lower the value of those assets. All right, because as they raise their lending rate, other institutions are going to raise as well. Now it says, Gross, the former chief investment officer for Pacific Investment Management Company, or Pimco, urged his followers on X, the social media platform formerly known as Twitter, to invest in the curve on bonds, which have been hit with a sell-off in recent months. Now, I'm also wondering if large asset managers like this are in such dire straits that they are desperately looking for buyers to come into this market. Think about that for a second. See, we always have to be leery of where their minds are at. I don't know why I just thought of this, but I put that link down below to the XRP silver coin collectible. The price is going up tomorrow morning because of XRP's price rise. So I put that down below. So there's my motivation, I guess. That's what made me think about it. It says here, yields on 10-year government bonds peaked at more than 5% last week, the first time in 16 years. While 30-year bonds similarly, I always screw up that word, spiked at approximately 5.2. So we're seeing across the board with these bonds, rates spiking higher. So that is going to drive more fear in people. They're not going to want to tie up their money for that long. It says, while some spectators, expect to see yields boosted by high base rate and an expectation that bond supply will increase, fly to more than 6% in certain timeframes, Gross and Ackman are convinced now is the time to scale back their bets on yields rising further. What they're trying to do is they're trying to get in near the top or at the top, buy a bond, build up a bond portfolio. And I'm going to be honest with you, I'm planning on doing this as well. All right, this isn't financial advice. But when we feel that we're getting close to a topping position or pattern in the bond rates on the yields, buying a bond portfolio, holding to maturity as rates come down. The problem is I do not see a scenario anytime soon. Personally, it isn't financial advice, I'm not a financial advisor. I do not see a scenario where we have a situation where rates can come down because the Fed has not brought unemployment higher. Countries are still selling their treasuries, and they're wanting to do it slow enough to where it doesn't just totally tank the market. And I'm going to do it, but I don't think that we're there. Just curious here. Type 3, if you, oh no, here, just do this. Type up, higher or lower if you think that rates are still going higher in 2024, or if they're going lower. You can put a thumbs up emoji or down, or higher or lower, but I'm curious what you guys think. I personally do not believe that we are going to see lower rates in 2024, which would not make me want to buy treasuries. On top of that, now think about this too. You have to be very concerned with this, especially when you're dealing with corporate debt, junk bonds, things like that. When you're investing, usually it's US government treasuries, the safest, but you are literally loaning your money to an insolvent entity. And the only thing that you have backing or giving you confidence in doing that is that, well, they've been number one top dog forever, you know, actually only like the last 50, 60 years. And so what's going to change? And that's when people get screwed. And that's what really concerns me. So right here, they're saying higher for longer is yesterday's mantra Gross wrote. So I believe that you're seeing them panicking and trying to get more activity in the bond market. Like I shared in the first video, all these bond issuance, these auctions, nobody's showing up for. All right, it's crickets. So you've got two massive investors going, oh, hey, it's great. Come on in, come on in. I have a feeling this might be their famous Jim Cramer moment, where a couple weeks before a bank collapses and the stock goes to nothing, Jim Cramer's out there going, hey, I think you should buy. I think this is a great time to buy Silicon Valley Bank. Just buy it. Buy the stock. Or whatever bank he was touting. I don't remember which one it was. You see what I'm saying? I think that what we're seeing is they need liquidity. I do not believe the bond market has enough liquidity, and that's why these rates, these yields keep spiking. Now, that's just me. That's some ninja logic. But I have a feeling you guys feel the same way. Now, it says here, thus far, many on Wall Street had hoped the Fed would pull off a so-called soft landing of slow growth, but not necessarily a recession. Bill Gross revealed he now disagrees, countering this is a quote from him, regional bank carnage and recent rise in auto delinquencies to long-term historical highs indicates U.S. economy slowing significantly. Now, I agree with that because I've been reporting on that, and you've been studying as well. We know the economy is slowing significantly, but it hasn't slowed in the way that the Fed wants it to show up, and that is in unemployment, because honestly, the government's cooking the books. They're sitting there, hey, look at this blowout, economy, because employment's great. Well, no, it's for every for every one full-time job, there's like 3 part-time jobs being invented. So the one part-time job, full-time job is going away and creating 3 part-time jobs. That doesn't help the consumer. That causes consumers to go, have 2, 3. I even found someone in Engine Nation that has 5 jobs. Now she's absolutely crushing it, and she's a young lady with lots of energy and ambition, and she's saving a ton of money. But man, I mean, who wants that, right? Who wants that? It would be nice to just show up to one job and be done. But anyway, sorry, I digress. So he says that everything's slowing down. He says here, and this is a tweet from Bill Gross's account, maybe next week we'll tweet on bonds, invest in the curve, various combinations, the 2, 10, the 2, the 5, should go positive before the year. He's buying SOFR futures, SOFR futures, Higher for longer is yesterday's mantra. And it's important when you see this kind of stuff coming out on social media and these big, you know, the bond king saying this. I do believe that he's going to be wrong. And I believe this is going to be a pretty amazing point or inflection point in his career, because we are in totally uncharted territory. Now it says here, the Fed isn't too worried about yields. For all the headaches Treasury yields are causing Ackman and Gross, the yield spike has actually done some of the work for the Fed, Chairman Jerome Powell said. And he's right. He hasn't had to come out and raise that rate, the base rate, because the 10-year is taking care of it for him. And it's pushing those mortgage yields higher. So it's slowing down the greatest wealth effect in our country, which is real estate. But it's not going to just slow down. It is going to run full steam into a wall. And that's why I am positioning myself. Thank you, BG, for the super chat. He says here, during the meeting of with the Economic Club in New York, Powell seemingly echoed some of the sentiments of his Fed colleagues who believe the rise in yields is tightening to help tighten the financial outlooks. Absolutely is. That's what we've been reporting on. As a result of the headwinds, Powell told his audience that at the margin, the friction might be less or might lessen the need for additional Fed rate increases in the future. See, what's really cool about this is one of the first times in history that the Fed is completely and utterly useless when it comes to flattening this curve. They are sitting back and letting the market meltdown happen perfectly. And most people don't even see it, that the market's melting down. That's why yields are screaming up. Companies and countries, governments are running out of money and having to pay higher rates. This is the most incredible thing, I think, that could be happening right now to prove to you that we are in very serious times. This is the time to save money, get serious about your credit score, and invest in inflation hedges. Thank you so much, Stacker, for the super chat. Thank you to everybody that hits the thumbs up. Thank you to everybody that supports this channel. I am so grateful to know you. I am so grateful to be a part of this movement. And I'm so very grateful to know people that see the bigger picture. 99% of the nation are not going to see this. It's going to wallop them upside the head. I want you, the 1%, Ninja Nation, and type 5 if you are chomping at the bit to take advantage of this crash. I want you to become wealthy. I want you to become very successful, more successful than you even believed in yourself. I want to throw the biggest party in the world by going around the world and highlighting your stories as you are crushing it in this downturn. There is going to be so much opportunity to absolutely dominate these markets. And for the first time, I believe in history of the United States, because of social media, there's people like myself out warning people and getting them ready for this ahead of time. You're not going to be a part of the 2008 crash this time. You're not going to lose your house. You are going to increase. Your household is going to increase because you are prepared and not scared. With that being said, I thank you to everyone that shares this video and everybody that hit the subscribe button today. Thank you so much for supporting me. The Economic Ninja is out.